Welcome, everyone. Today, we're going to tackle a huge concept in Canadian business tax, capital cost allowance, or as you'll always hear it, CCA. Now, if you're coming from your accounting classes, you've probably wondered, wait, what happened to depreciation? Well, for tax purposes, we throw it out and use this system instead. We're going to break down what CCA is, why we even have it, and exactly how it works. Let's get right into it.
Just a quick note before we begin. This explainer was prepared by Dr. Samir Al-Rashani with AI support.
So here's our game plan. First, we'll look at the fundamental problem with standard accounting depreciation, why it just doesn't work for taxes. Then, we'll introduce CCA as the government solution. After that, we'll get our hands dirty with the actual calculations. We'll also cover the absolutely critical idea of pooling assets and what happens when you sell them. And finally, we'll touch on a few key special rules that you've just got to know.
Okay, so let's start with the big why. Why did the government go to all the trouble of creating a completely separate system for writing off capital assets? It all boils down to a single major issue with the accounting principles you've already learned.
You know this stuff from accounting, right? Amortization is all about spreading an asset's cost over its useful life. But to do that, you have to estimate its useful life, you have to estimate its salvage value, and you have to decide on a method. That word, estimate, that's the whole problem. It's subjective, and subjectivity is something the tax system really tries to avoid.
And this slide just lays it out perfectly. Imagine two businesses, A and B. They both buy the exact same asset for 10 grand. But business A says, I think this will last 4 years, while business B estimates 6 years. Right away, their annual tax deductions are different. And because a tax dollar you save today is worth more than one you save years from now, this isn't fair. It means one business could end up with a lower real cost for the exact same asset just because of an accounting choice. That's not a level playing field.
So, this leads to the central question the government had to solve. How do you create a system that's fair and consistent for every single business, no matter how big or small, no matter what they do? How do you level that playing field?
And the answer, as you've probably guessed, is capital cost allowance. The solution was to say, okay, forget your internal estimates. For tax, everybody plays by the exact same set of rules. It's a standardized, uniform system for everyone.
So here's the core idea. CCA is the mandatory system for tax. It takes all the different kinds of assets a business might buy, groups them into specific categories called classes, and then assigns a fixed, non-negotiable deduction rate to each one. No more guesswork, no more subjectivity.
Now, before we do any math, we need to get two key terms down. First, capital cost. This isn't just the price on the invoice, it's the total cost to get that asset in place and ready to work. So think purchase price, plus delivery, plus installation, legal fees, all of it. Second, and this is the big one, undepreciated capital cost, or UCC. Just think of UCC as the running balance of an asset pool. It's the amount you still have left to claim a deduction on. Okay, let's pop the hood and look at the calculation engine. For most assets, the CCA system runs on something called the declining balance method. All that means is you apply a fixed percentage to a balance that gets smaller and smaller each year.
This slide shows you the annual cycle. It's pretty straightforward, really. You start the year with whatever UCC balance was left over from last year. You add the capital cost of any new stuff you bought. Then you subtract whatever money you got from selling old assets from that same class. What's left over is your base for the CCA claim. You just multiply that base by the class rate, and that's your maximum tax deduction for the year. Simple as that.
And here are some of the most common classes you'll bump into. You can see the logic here, right? Class 1 for buildings is a really slow rate, only 4%, because buildings last a long time. Class 8 is a huge catch-all for stuff like office furniture and equipment at 20%. Vehicles are in Class 10 at 30%, and then you get to the really fast classes, like Class 50 for computer hardware at a whopping 55%, and even Class 12, which is a 100% write-off for things like small tools or certain software.
Now, there's a really cool rule that basically turbocharges your deduction in the very first year you buy an asset. It's called the Accelerated Investment Incentive. The government wants to encourage businesses to invest, so for most new assets, they let you claim 1.5 times the normal CCA amount in that first year. It gives you a much bigger tax break right up front.
All right, this next part is maybe the most important concept in all of CCA. We do not track individual assets. I'll say that again. We don't track individual assets. Instead, everything in the same class gets tossed into one big pool, and we only ever track the total UCC balance of that pool.
This example makes it super clear.
So in year 1, a company buys a building for $500,000. Using that accelerated incentive we just talked about, they get a CCA claim of $30,000. Their UCC balance drops to $470,000. Okay, simple enough. But in year 2, they buy another building for $300,000. They don't start a separate calculation. They just dump that cost right into the existing pool. Their new UCC is now $770,000, and that's the number they use to calculate their CCA for year 2. The two buildings have lost their individual identities. They're now just one lump sum in the Class 1 pool.
So what happens when you sell something? Well, because of this pooling, you can get two very special results, and you absolutely need to know these, especially for exams. If you sell an asset for a lot of money and it drives the UCC balance of the pool below zero, that negative amount is called a recapture. It gets added right back into your income that year. Basically, the government is saying you claimed too much CCA in the past and now they're taking it back. On the flip side, if you sell the very last asset in a class and there's still a positive UCC balance left over, that's called a terminal loss. You get to deduct that entire remaining amount from your income all at once.
Now, just when you think you've got the main method down, it wouldn't be the tax system without some exceptions, right? There are a bunch of important special rules for specific kinds of assets that don't follow the normal declining balance method.
Let's just run through a few of the big ones. For things like leasehold improvements in Class 13, you don't use declining balance. You use straight line over the life of the lease. Same thing for Class 14 assets, like a franchise agreement that has a fixed term. Now intangibles, with an unlimited life, like goodwill, they get their own special class, 14.1, at a 5% declining balance rate. And finally, a really common one. What if you start using your personal car for your business? The tax rules say you deem to have sold it to your business at its fair market value, and that value is what you start claiming CCA on.
And that brings us to the end. I want to leave you with a question to chew on. The CCA system was really designed for a physical world, buildings, machines, trucks. But today, the most valuable assets for many companies are completely intangible, things like software, data, brand recognition, websites. So how well does our current system of classes and rates actually handle this new reality? And looking forward, how might it need to change? It's something important to think about. Thanks for your attention.